Most traders believe profitable trading comes from finding better entries. That's the belief that keeps many people searching for the next indicator, the next strategy, the next secret. But what if profitability has far less to do with where you enter and far more to do with how you understand what you're seeing? Look at the market for a moment. Every price movement is a reflection of human behavior: fear, greed, hope, regret. The chart is simply the record of those emotions expressed through buying and selling. Yet most traders study the chart while ignoring the people behind it. Have you ever wondered why the same pattern sometimes works perfectly and other times fails immediately? The answer isn't hidden in the pattern itself. A setup has no power on its own. Its meaning depends on context. A breakout after weeks of accumulation tells a different story than a breakout after an emotional rally. The shape may look identical, but the behavior underneath is completely different. When you learn to recognize that difference, trading begins to change. Think about what happens when traders become impatient. They chase price because they fear missing out. Their decisions become emotional instead of logical. What usually follows? Poor entries, weak risk management, and unnecessary losses. Because creates effect. The emotional decision comes first, the financial consequence comes second. This is why profitable trading starts with observation, not prediction. Observation. Can you identify who is trapped? Can you see where traders are likely feeling pressure? Can you recognize when a move is attracting late buyers instead of strong buyers? These questions matter because markets often move against the majority at the moments when confidence feels highest. Now here's something worth considering. Many traders focus on being right. Professional traders focus on managing uncertainty. The difference sounds small, but it changes everything. When your goal is being right, you resist information that challenges your opinion. When your goal is understanding uncertainty, you remain flexible. And flexibility is a competitive advantage. The market doesn't pay you for your opinions. It pays you for your decisions. A trader can correctly predict direction and still lose money through poor execution. Another trader can be wrong frequently and still remain profitable because losses are controlled and winners are allowed room to develop. Have you noticed how the best opportunities often feel uncomfortable at first? That's because crowd behavior creates distortions. By the time a trade feels obvious, much of the opportunity may already be gone. Understanding this relationship between comfort and opportunity helps you interpret market behavior more clearly. So what should you actually look for? Watch how price behaves around important levels. Observe whether momentum expands or weakens as price approaches them. Pay attention to failed moves. A failed breakout often reveals more information than a successful one. Why? Because failure exposes expectations that the market refused to fulfill. And when expectations fail, traders react. Their reactions create new opportunities, new imbalances, new movements. This is where profitable trading begins, not with certainty, not with prediction, but with the ability to understand behavior before the crowd fully recognizes what is happening. Most traders believe success in the market belongs to the smartest person in the room. They think the trader with the most indicators, the most advanced strategy, or the deepest market knowledge has the greatest advantage. But if intelligence alone created profitable traders, why do so many intelligent people struggle to make money consistently? The market has a way of exposing a weakness that knowledge alone cannot fix. Patience. Think about what happens after a trader discovers a new setup. Almost immediately, the urge appears to use it. The trader starts looking for opportunities everywhere. Every small movement begins to look like a signal. Every pullback seems like an entry. Every breakout appears ready to run. The desire to participate becomes stronger than the need to wait, and that is where many losses begin. The market offers opportunities every day, but profitable opportunities are far less common. Most price movement is noise. Most candles tell no meaningful story. Most sessions provide little edge. Yet traders often feel pressure to act simply because the market is open. Have you ever noticed how difficult it feels to do nothing? For many traders, sitting on their hands feels unproductive. They believe activity equals progress. They believe more trades create more chances to make money. But the market does not reward activity. It rewards selectivity. The patient trader understands something important. Every trade carries risk, but not every trade deserves that risk. This changes the way decisions are made. Instead of searching for reasons to enter, the patient trader searches for reasons to stay out. Instead of forcing opportunities, they allow opportunities to reveal themselves. Instead of reacting to every movement, they wait for conditions that align with their plan. At first glance, this may seem slower. In reality, it is often faster. Why? Because impatience creates unnecessary losses, and every unnecessary loss requires time, effort, and emotional energy to recover. A trader who takes 5 poor trades may spend weeks repairing damage that could have been avoided by waiting for one quality opportunity. Cause and effect are always present in trading. Impatience leads to overtrading. Overtrading leads to emotional decision-making. Emotional decision-making leads to inconsistency. The chain begins long before the loss appears on the screen. Patience breaks that chain. Consider how professional traders approach uncertainty. They understand that the market will still be there tomorrow. They know another setup will appear. They do not fear missing one move because they recognize that opportunities are endless while capital is limited. Can you see the difference in mindset? The impatient trader thinks, "What if I miss this trade?" The patient trader thinks, "What if this trade isn't worth taking?" One mindset is driven by fear. The other is driven by discipline. This distinction becomes even more important during periods of excitement. When markets move quickly, emotions intensify. Traders see others making money and feel compelled to join. Suddenly, waiting feels impossible. The fear of missing out becomes stronger than objective analysis. Yet this is often when patience becomes most valuable. Strong emotional environments encourage weak decisions. The crowd becomes focused on immediate outcomes rather than quality decisions. Prices accelerate, expectations expand, and discipline weakens. The patient trader remains focused on process. They understand that a missed opportunity costs nothing. A bad trade costs both money and confidence. That is why patience should not be viewed as passive behavior. It is an active skill. It requires resisting impulses, ignoring distractions, and maintaining discipline when others are losing theirs. The market constantly tests this skill. It presents tempting situations that appear promising but lack true quality. It creates movement that attracts attention without providing genuine opportunity. It encourages traders to act before evidence is complete. Those who cannot wait often pay tuition to the market. Those who can wait begin to notice something interesting. The best opportunities rarely need to be chased. Most traders look at price as if it is giving instructions. A candle rises sharply, and they think they should buy. A candle falls aggressively, and they think they should sell. Every movement feels like a command that demands action. But price is not telling you what to do. Price is giving you information. The difference may seem small, yet it separates disciplined traders from emotional traders. Think about it for a moment. If price were an instruction, then every trader looking at the same chart would make the same decision. But that never happens. Some traders buy while others sell. Some hold while others exit. The same price movement produces completely different actions. Why? Because price itself contains no instructions. It only contains information. The challenge is learning how to interpret that information correctly. When a stock suddenly rallies, many traders immediately assume strength. They see green candles and feel compelled to participate. But is the move truly strong, or is it simply attracting emotional buyers? The price movement alone cannot answer that question. You must look deeper. What happened before the move? Where did it begin? How did volume behave? Was the market expecting the rally, or was it unexpected? These questions transform price from a signal for action into a source of understanding. Have you ever noticed how traders often buy after seeing a large move upward? The move itself becomes the reason for the trade, yet the move may actually be providing a warning rather than an opportunity. A trader who treats price as an instruction reacts emotionally. A trader who treats price as information becomes curious. Instead of asking, "Should I buy?" they ask, "What is this movement telling me?" That question changes everything. Curiosity slows decision-making. It creates space between observation and action. And in trading, that space is incredibly valuable. Many losses occur because traders confuse movement with meaning. A breakout, for example, is not automatically bullish. It is information. The market is showing that price has moved beyond a certain level. What happens next determines whether the information is useful. Will buyers continue supporting the move? Will sellers absorb the demand? Will momentum expand or disappear? The answers matter far more than the breakout itself. This is why experienced traders spend less time predicting and more time observing. They understand that the market is constantly communicating through price. Every rally, pullback, rejection, and consolidation reveals something about the balance between buyers and sellers. Price becomes a language, and like any language, understanding comes from interpretation, not reaction. Consider what happens during a sharp decline. Most traders immediately focus on fear. They see falling prices and assume more downside is coming. Sometimes that assumption is correct. Sometimes it is not. A decline may represent panic selling near exhaustion. It may reveal trapped participants. It may signal opportunity rather than danger. Without context, price provides information but not conclusions. Can you see why patience becomes important here? When traders rush to act, they often make decisions based on incomplete information. They assume the first message is the entire story, but markets rarely reveal everything at once. Information unfolds. Price moves. Participants react. New information emerges. Conditions change. The trader who waits gains access to a clearer picture. The trader who reacts immediately often commits before understanding what is actually happening. This principle applies to every time frame and every market. Whether you trade stocks, futures, forex, or cryptocurrencies, price serves the same purpose. It reflects behavior. It reveals decisions. It exposes emotions. But it never tells you exactly what to do. That responsibility belongs to you. The market provides information. Your process determines how that information is interpreted. Without a process, every candle becomes a temptation. Every move becomes a potential distraction. Every fluctuation feels important. With a process, price becomes something different. It becomes evidence. One of the most expensive habits in trading is the need to be right. Most traders never recognize it because it sounds like a strength. After all, who doesn't want to be right? Who doesn't want their analysis confirmed, their prediction validated, and their trade rewarded? But the market does not care about being right. The market cares about how you respond when you're wrong. Think about what happens the moment a trader enters a position. Almost immediately, the trade becomes personal. The analysis is no longer just an idea. It becomes part of the trader's identity. If the trade wins, confidence rises. If the trade loses, the ego feels challenged. This is where problems begin. A trader who needs to be right starts defending positions instead of evaluating them. Evidence that supports the trade is accepted. Evidence that contradicts it is ignored. The goal quietly shifts from making money to protecting an opinion. Have you ever held a losing trade longer than planned because you were convinced the market would eventually prove you correct? Most traders have. At first, the loss seems temporary. Price moves slightly against the position, but the trader remains confident. Then the loss grows. Instead of reassessing, they search for reasons to stay in. News, indicators, opinions, social media posts, anything that supports their existing belief becomes valuable. The market keeps sending information. The trader keeps rejecting it. What started as a manageable loss becomes a serious problem. The hidden cost is not just financial. The need to be right affects every decision that follows. When traders become attached to predictions, flexibility disappears. They stop observing objectively. They stop adapting. Instead of responding to current conditions, they continue fighting for a past opinion. And markets punish rigidity. Conditions change constantly. Buyers become sellers. Strength becomes weakness. Trends become ranges. A trader who cannot adjust becomes trapped in outdated thinking. This creates a dangerous cycle. The stronger the attachment to being right, the harder it becomes to admit a mistake. The harder it becomes to admit a mistake, the larger the loss often grows. The larger the loss grows, the more emotional the decision-making becomes. What began as a small issue turns into a major obstacle. Professional traders understand something that many beginners overlook. Every trade is simply a probability. Nothing more. A setup may have an edge. A strategy may have a positive expectancy. But no individual trade carries certainty. Once this idea is fully accepted, the need to be right begins to lose its power. Why? Because being wrong no longer feels like failure. It becomes part of the process. Imagine a trader with a strategy that wins only half the time. If that strategy is profitable over hundreds of trades, does being wrong on one trade matter? Not really. Yet many traders react as if every losing trade is a personal judgment of their ability. This emotional response creates unnecessary pressure. Pressure leads to hesitation. Hesitation leads to inconsistency. Inconsistency destroys performance. The irony is that traders who focus on being right often achieve the opposite result. Their desire for certainty makes them less objective. They exit winners too early to protect gains. They hold losers too long to avoid admitting mistakes. The behavior feels logical in the moment. The outcome rarely is. Have you noticed how some traders can quickly close a losing position and move on without emotion? It is not because they enjoy losses. It is because they understand the purpose of trading. The goal is not to prove intelligence. The goal is not to win every argument with the market. The goal is to manage risk while positioning yourself for favorable opportunities. That requires humility. Humility allows a trader to recognize when conditions have changed. It allows them to abandon ideas that are no longer valid. It allows them to prioritize evidence over ego. This is why the market often rewards flexibility more than conviction. Conviction can help a trader stay focused. Too much conviction can blind them. Every chart, every setup, every position is sending information. The trader who needs to be right filters that information through personal bias. The trader who values understanding remains open to what the market is actually revealing. Most traders spend their time trying to predict what the market will do next. They study indicators, patterns, and forecasts, hoping to gain an advantage. Yet many overlook the most important force behind every market movement: the crowd. Markets are not driven by charts. Charts are simply the visible record of human behavior. Every rally, every decline, every breakout, and every panic reflects the collective decisions of thousands or even millions of participants. If you want to understand price, you must first understand people. This is where many traders struggle. They assume that because everyone has access to the same information, everyone will react rationally. But markets are not governed by logic alone. They are influenced by emotions, expectations, beliefs, and fear. Have you ever wondered why prices sometimes continue rising long after they seem expensive, or why strong assets occasionally fall despite positive news? The answer often lies in crowd behavior. People do not buy simply because something has value. They buy because they believe others will continue buying. They do not sell simply because conditions have changed. They sell because fear spreads faster than logic. Crowd behavior creates momentum. Momentum attracts attention. Attention attracts more participants. The cycle feeds itself. At first, a move may begin for legitimate reasons. Strong earnings, improving fundamentals, or changing economic conditions can attract buyers. As price rises, more people notice. The move gains visibility. Confidence grows. Soon, many participants are no longer buying because of the original reason. They are buying because the price is already rising. This shift matters. When behavior becomes driven by emotion instead of analysis, vulnerability increases. Expectations become elevated. Traders become less objective. Risk begins to hide beneath confidence. The crowd rarely notices this transition while it is happening. That is why understanding crowd behavior provides an advantage. You stop focusing solely on price and start paying attention to the people behind the price. What are they feeling? What are they expecting? Where are they likely positioned? These questions often reveal more than indicators ever will. Consider what happens during a strong rally. As prices continue climbing, confidence spreads. Financial media becomes more optimistic. Traders begin discussing targets that seemed unrealistic only weeks earlier. Participation increases. But something interesting happens at the same time. The later people join, the fewer buyers remain available to push prices higher. The crowd sees strength. The observant trader sees potential exhaustion. The same principle works in reverse. During sharp declines, Fear grows rapidly. Negative headlines dominate conversations. Participants become convinced that lower prices are inevitable. Many begin selling not because they have carefully evaluated the situation, but because everyone around them appears concerned. Fear becomes contagious. The crowd sees danger. The observant trader sees emotional pressure reaching an extreme. This does not mean the crowd is always wrong. That is a common misunderstanding. The crowd often drives trends for long periods. Fighting strong momentum simply because many people agree can be costly. The goal is not to oppose the crowd automatically. The goal is to understand it. Can you identify when the crowd is acting rationally and when emotion is beginning to dominate? That distinction is critical. When emotions remain controlled, trends can continue. When expectations become excessive, conditions become unstable. The shift is often subtle at first. Price may continue moving higher. Confidence may continue increasing. Everything may appear healthy. Yet beneath the surface, risk is quietly expanding because behavior is becoming less disciplined. This is why experienced traders pay close attention to reactions rather than predictions. They observe how participants behave when expectations are challenged. They watch failed breakouts, unexpected reversals, and emotional responses to news. These moments reveal information. They expose where traders are trapped. They reveal where confidence is weakening. They show where beliefs and reality are beginning to separate. One of the most common mistakes in trading is confusing rising prices with real strength. At first, that may sound strange. After all, if price is moving higher, doesn't that mean the market is strong? Not necessarily. A price move tells you what happened. It does not automatically tell you why it happened. And understanding the difference between the two can dramatically change how you interpret the market. Most traders see a strong green candle and immediately assume buyers are in control. They see momentum and conclude that more upside is likely. The movement itself becomes evidence of strength. But is every rally truly strong? Think about it for a moment. A market can rise because institutional buyers are steadily accumulating positions. It can also rise because emotional traders are rushing in out of fear of missing out. Both situations may produce similar price action, yet they represent completely different conditions. One is sustainable. The other may be fragile. The challenge is that many traders focus only on the visible outcome. They see price moving higher and stop asking questions. They assume the market is revealing strength when it may actually be revealing enthusiasm. And enthusiasm is not always strength. Have you ever noticed how some of the strongest looking moves suddenly reverse without warning? Many traders are surprised when it happens. In reality, the warning signs were often present long before the reversal occurred. The problem is that most participants were watching the price while ignoring the behavior behind it. Real strength tends to show consistency. It attracts demand without excessive excitement. Pullbacks remain controlled. Buyers continue appearing when price weakens. The market advances with a sense of stability. Weak strength looks different. Price may rise rapidly, but participation becomes emotional. Traders chase moves. Expectations expand quickly. Confidence grows faster than evidence. The rally becomes increasingly dependent on new buyers entering at higher prices. That dependence creates risk, because eventually the supply of eager buyers begins to shrink. When that happens, even small amounts of selling can create larger reactions than most people expect. Cause and effect are always connected. As excitement increases, discipline often decreases. As discipline decreases, vulnerability increases. As vulnerability increases, markets become more sensitive to disappointment. This is why strong markets do not always feel exciting, and exciting markets are not always strong. That distinction catches many traders off guard. Consider what happens near major highs. Confidence is usually elevated. News appears positive. Market participants feel optimistic. The environment seems supportive. Yet these conditions often exist because prices have already risen significantly. The crowd interprets the recent success as evidence that future success is guaranteed. The experienced trader becomes cautious, not because the market must reverse, but because expectations are becoming increasingly one-sided. Can you see why expectations matter so much? Markets do not move solely because of current conditions. They move because reality either meets or fails to meet expectations. When expectations are low, even modestly positive developments can create strong advances. When expectations are extremely high, even good news may fail to push prices higher. This is where many traders misread strength. They focus on what is happening today, while ignoring what participants have already anticipated. A truly strong market often absorbs negative information without significant damage. Buyers remain committed. Selling pressure struggles to gain traction. Weakness is quickly bought. That behavior reveals resilience, and resilience is a more reliable sign of strength than a large green candle. The same principle applies on smaller time frames. A breakout that immediately attracts follow-through reveals commitment. A breakout that stalls despite favorable conditions may be signaling something entirely different. Price provides clues. Behavior provides meaning. Most traders enter the market believing their job is to predict the future. They spend countless hours searching for certainty. They look for indicators that promise accuracy, strategies that claim precision, and opinions that appear confident. Everything revolves around one goal, figuring out what price will do next. But profitable trading rarely begins with prediction. It begins with observation. That may seem like a small distinction, yet it changes the entire approach to the market. Prediction focuses on what you think will happen. Observation focuses on what is actually happening. One is based on expectation. The other is based on evidence. Many trading mistakes occur because traders become attached to forecasts. Once they develop an opinion, they begin filtering information through that opinion. They stop observing objectively and start searching for confirmation. The market keeps changing. Their perspective does not. Have you ever entered a trade because you felt certain about the direction, only to watch the market behave differently than expected? Most traders have experienced this. The problem was not necessarily the analysis. The problem was becoming committed to a conclusion before enough information was available. Observation prevents this trap. An observant trader approaches the market with curiosity rather than certainty. Instead of deciding what must happen, they pay attention to what participants are actually doing. They watch how price reacts around important levels. They notice whether momentum is increasing or fading. They look for evidence before forming conclusions. This process creates flexibility, and flexibility is one of the most valuable skills a trader can develop. Think about how a scientist approaches an experiment. The goal is not to prove a personal belief. The goal is to collect information and understand reality. If the evidence changes, the conclusion changes. Markets demand the same mindset, yet many traders do the opposite. They create a prediction first and then spend the rest of the day defending it. Observation works differently. It allows the market to reveal information gradually. A breakout occurs. You observe. Volume expands. You observe. Follow-through buying appears. You observe. Only after collecting enough evidence do you begin building confidence in a particular idea. Can you see how this reduces unnecessary mistakes? When traders rush to predict, they often act before conditions become clear. They commit capital based on assumptions rather than evidence. As a result, they find themselves reacting emotionally when reality differs from expectations. Observation slows the process, and slowing the process often improves the quality of decisions. This is especially important during periods of uncertainty. Markets frequently produce conflicting signals. Price may appear strong on one time frame and weak on another. News may seem positive while participation remains hesitant. Conditions may be changing beneath the surface. A trader focused on prediction feels pressure to choose a side immediately. A trader focused on observation remains patient. They understand that information has value. The more accurately they observe, the better they can interpret what is developing. Observation also helps reveal opportunities that prediction often misses. Many of the best trades begin quietly. They do not announce themselves with certainty. They emerge through subtle changes in behavior. Selling pressure weakens. Buyers become more active. Reactions around key levels begin to change. These shifts are often invisible to traders who are busy forecasting. But they stand out to traders who are paying attention. Cause and effect play an important role here. Observation improves understanding. Better understanding improves decision making. Better decision making improves consistency. The process starts long before a trade is placed. It starts with seeing clearly. This is why experienced traders spend less energy trying to predict every movement. They recognize that certainty is rarely available. Instead of forcing conclusions, they gather information. Instead of assuming, they observe. They know that the market constantly provides clues about the intentions, emotions, and positioning of participants.